Hi students, so today we learn about gearing ratios. So there are two types of ratios that we have to learn over here. The first one being debt by equity and the other one being interest cover. So first let's look into debt by equity. So debt to equity ratio is a financial metric that provides insights into a company's capital structure and financial leverage. So it is calculated by dividing the company's non-current liabilities by equity. Over here, what do you say, they want to know whether the company's proportion of financing that comes out of debt compared to equity. That is what is looked into in this ratio. So high debt to equity ratio indicates that the company relies more on debt financing, which can increase financial risk. On the other hand, we can say that low ratio suggests a lower level of financial leverage and may indicate that we have a more conservative capital structure whereby we are relying more on the equity funding. So it is whenever the gearing is increasing, we can say that high gearing brings in high financial risk, but it is not always the case. If you have enough non-current assets in comparison to your non-current liabilities, if you have more non-current assets in comparison to your non-current liabilities, we can say that we have more assets to keep as security for our non-current liabilities. Now, in such a situation, while you're doing your ratio analysis, you have to say that the risk is not that high as we think, because we have enough non-current assets to keep as a collateral for our non-current liabilities. So these kind of judgments are judgments which the examiners are looking into. And sometimes what happens is your gearing may seem to fall. That does not mean that your debt has reduced. It may be because your equity has increased due to revaluation surplus, increasing due to a revaluation gain. So you have to check into these elements whether these are the situation which is going on. So you have to put focus into that, and you must clearly mention in your answers why your gearing is low or why your gearing is high. If you have taken more depths, your gearing might go high. If you have what do you say, if you have if you have issued more shares, your gearing may go low. That is not because your liabilities have been set off, it is because you have issued more shares and your equity has increased. So you have to understand, check the question, what is going on in the question and what is the reason for the change in the ratio. Okay, then looking at interest cover. Interest cover ratio is looking at whether you have enough profits to cover your interest, and if you have enough profits, how many times can you cover your interest. So over here it again connects to your gearing ratio. See, if your gearing is high due to high what do you say, non-current liabilities, or due to high debt funding, then automatically your interest coverage will go low because your interest is going to increase. The same way your profitability also affects your interest cover, because if your profitability is high, you'll be easily able to cover your interest. But if your profitability is low, then your interest coverage ratio will fall down. So whatever reasons affected your profitability ratios, like gross profit, net profit ratios, the same thing is going to affect in interest cover as well. So you can pick out from your answer the same points that you've written for your net operating profit ratio and gross profit ratio and pull it down to match your answer in interest cover. So these are the ways which we can use the reasons that we have mentioned above in our answer, so that you can get a perfect answer. So over here we looked into two ratios, that was gearing and interest cover. And in gearing ratio also I told that higher the gearing, higher the risk, and lower the gearing, lower the risk. But not always high gearing means high risk. You have to check your non-current assets exceeding your non-current liabilities. If it is exceeding, then there is not much risk. If it is not exceeding, then there is risk. Okay, then talking about gearing, it is not always increasing due to more debts or decreasing due to when you're settling off your debts. It may be due to the differences in your equity part also, so check that too. See, sometimes what happens is your equity falls down due to an impairment. So when there's an impairment of an asset which was previously revalued, your revaluation surplus goes to nil. So that can be the reason for increase in gearing. It may not be because you have taken up more debts. So look into these reasons that I'm mentioning right now, and connected with your question, you can find out some solution out of it, which you can write it in your answer. So I think this was helpful. Bye. Take care.